Hi, everybody, and welcome to another edition of 18 Minutes with 180 Markets. And well, friends, we certainly are in a commodity super cycle. But let's not paint all commodities with that same brush. We need to differentiate. Well, how do we do so? Well, we are joined today with a very special guest, Ben Cleary of Tribeca, because Ben has been around the markets for many years, certainly understands commodities, and also has the track record to back it up. And with that introduction, Ben, welcome.
Great to be here, Greg. Thank you for the invitation.
Hey, hey, Ben, maybe we should start out with the top, as I said. When you look at the commodity market today, just spend a couple minutes of focusing on not only the commodities that you're focusing on, but also the ones that maybe you're avoiding, if any.
Yeah, sure. Thank you. Thank you for your time once again. Yeah, look, in terms of the super cycle, we agree that the next 5 years in particular, look very strong in terms of outlook for most commodities. It's sort of a mix of both demand and supply. On the demand side, I think probably got two of the biggest investment themes that I've certainly seen in my investing career playing out at the same time. And those two are, firstly, defense spending. We're seeing, defense spending um, across the G20 hit its highest levels in more than 50 years. Defense spending's a bipartisan topic through almost all of the G20 countries. So it's not likely to be affected by electoral cycles. Defense spending is long-term in nature. You generally see at least 10-year type procurement for defense, and the impact that that's going to have on commodities, particularly the critical metals
Right.
that are going into the rearmament of these countries is going to be very significant. The second thing is the AI thematic, particularly around the energy that is going to be required for data centers. And we see that the energy required within that AI sector is going to drive energy growth right across the G20
For
in
sure.
in the sort of mid single digits per annum, at least for the next 5 to 10 years. And that's sort of within a backdrop of energy declining for really the last 30 to 40 years off of the back of improving automation of things like air conditioners or other white goods and what have you. Energy consumption has been falling for a long period of time. Now it's going to grow. It's going to grow at a very quick pace. So that's really feeding into everything from nuclear energy through to copper, in terms of the transmission of that energy. So these two themes,
Right.
really are playing out in at the same time. And it was the first time since the 1930s, so almost 100 years, that the US declared wartime procurement. The last time they declared it, it lasted for almost 15 years.
Wow.
So, that happened mid-July. 1 week later, around the 20th of July, released for his fundraising, tour to accelerate, data centers and investment into, the AI space within the US. Those two things played out literally within a week of, one another last July. And obviously we saw a
Yeah.
lot of capital come into both of those themes in the back half of last year. I think that's somewhat been stalled just with the ongoing issues in Iran, just in
Right.
terms of risk,
Uncertainty.
generally uncertainty. But the tenor of both of those themes is multi-year, by nature.
Yeah, these are
And
seismic plates, if you will.
absolutely. And I think the way I sort of think about it is that certainly in the last 25 years, that the biggest investment thematic in terms of commodities was Chinese urbanization. And we had that really play out throughout the 2000s, and the impact that that 400 to 500 million people coming
Yeah. Yeah.
into the middle class in
Yeah.
in in China, and the associated impact that had in commodities. We really, didn't think we'd see another impact like that within our lifetime. But both of these themes, defense spending and AI capital spending, is in fact bigger in their own right
Really? Okay.
than
Wow.
Chinese urbanization in terms of impact on commodity consumption. So that's your demand side.
Yeah.
Your supply side is very simple. There is no new, there is supply is not keeping up with demand
Right.
in terms of, every almost every single commodity that we look at. And that is, you know, thanks to underinvestment in exploration, underinvestment in producing assets,
And permit
and
issues, Ben.
and and all of the associated issues around that, like permitting, like cost inflation. These are not, transitory issues in our view. They're very sticky.
Right.
They're not going away. Permitting, across the globe, whether it's emerging markets or developed markets, is seeing new discoveries taking longer and longer to come into production. And, if you made a discovery 20 years ago,
Right.
something like, say, Sandfire, when it first discovered DeGrussa in
Right.
Western Australia, it took about 2 years from discovery drill hole to the first tons that were being produced out of DeGrussa. These days, you're looking at least 10 years. And in America, you're looking at 15 to 20 years. And for all of the, drill baby drill type rhetoric, that
Right.
a lot of the time these permitting issues are state based.
Right.
So the federal sway, if you will, really doesn't change these permitting delays. And look, in a lot of these cases, permitting delays make a lot of sense, because as populations get larger,
Right.
uh, the competition for land is naturally increasing. And whether that's for energy, whether that's for mining, whether that's for
Right.
roads, whether that's for residential, all of these sorts of, issues are just, that's why I say they're not, um, transitory, they're
Yeah.
structural. So,
Yeah.
you know, long-winded answer to your question, are we in a super cycle? I think we absolutely are, because we've got really strong demand at the same time that we've got structural supply problems. It's just going to mean that commodity prices need to remain elevated, or in fact move higher, before you're going to see any sort of supply response to
Yeah.
meet that ongoing demand.
And
Um,
yeah, that makes sense. And Ben, speaking of, taking it more narrow now to Tribeca, how do you express these views, if you will, and especially maybe if you focus on how you focus on some smaller companies as well?
yeah, so most of the team, worked together for, the last sort of 20, 25 years, in previous lives in investment banks, now in a fund environment. We we look at commodities, very similar to, how an investment bank would, in terms of looking at the demand and supply of the different commodities. We then overlay our macro views, and then we overlay a positioning um, data over the top. And so, what does that really look like in theory? If I think that, say, pick a commodity, copper
Right.
has really strong demand, has a lot of supply challenges, over coming years. I've got a strong fundamental view of copper.
Right.
Ideally, from a macro perspective, I'm going to want to also have, a macro view that, Chinese fixed asset investment's going to be strong. Maybe the US dollar's going to weaken.
Right.
Maybe, yields are going to weaken. And then ideally, I'm going to want, from a positioning perspective, there to be, not a lot of ownership of copper. I
Right.
don't want it to be a consensus long
Right.
already.
But it's baked
And
into the price. Yeah.
that's baked into the price. So, ideally, you're going to want to see, very low levels of ownership, very strong macro expectations that support the fundamental view. And we're looking across all commodities, both hard rock, energy, and soft commodities in the same fashion. We're then getting a batting order
Right.
in terms of what commodities we like the most, which ones we dislike the most, and
Right.
then we're trying to implement those views mainly by equities. We can invest in commodities directly. We prefer equities and credit
Yeah.
because we don't have physical capabilities for
I see.
delivery in terms of commodities. And that's why we love investing in, great businesses like Glencore or Vitol or Trafigura that do have
Right.
the
I was just gonna
ability to
say,
trade commodities
yes.
because they've also got that ability to the infrastructure to be able to take delivery.
Yeah.
And it's been a very strong view, of mine that you don't pay a fund manager to trade commodities if they don't have that physical capability.
Right.
And it's a bit like in COVID, we all know oil went to zero, it went negative.
Right.
Well, no one was able to take advantage of that in the paper market. You
Right.
had if you didn't have the ability to physically
Yeah.
deliver um, and take delivery of, then you couldn't take advantage of that.
Yes.
Um, I think about like the nickel squeeze of 2022, 23 when the world's biggest hedge fund, Elliott Advisors,
Yeah.
are sitting on a multi-billion-dollar profit from their positions in nickel. And nothing against Elliott. I think
Yeah.
they've got a wonderful track record, but
Yes. Very
this
good.
is the one of the biggest hedge funds in the world. Um, that saw the LME, the London Metals Exchange, which is owned by the Hong Kong Exchange, cancel all the trades that went on in nickel, which reversed all of the P&L that they'd generated. They took them to court. This is one of the more successful litigants in terms of hedge funds
Yes.
globally, and they lost. So if a fund like that
Right.
can't make money out of paper trading commodities, or you don't
Right.
have physical capabilities like Glencore, I just would much prefer to be invested in the producers of the commodities themselves,
Right. You're at a
versus the
disadvantage.
commodity. And of course, you get balance sheet and operating leverage as well by picking, good stocks. So if I kind of look at our returns over the last 10 or 15 years, about half of the returns have probably come from picking the right commodities,
Right.
but the other half have, come from just picking great companies.
Right.
And, I always say that, sticking with a small number of companies that you know really well, you
Okay.
know the asset well, and you know the management team well, is always better than having a broad brush approach in this space. So yeah, we look at the commodity, we analyze what we like, dislike, and then we're trying to express those views in generally companies that have got the best operational torque to those commodity views.
And speaking of that, Ben, why don't we use a live example? It's in the public domain. Cobre, a copper company. Maybe just talk to us through what I'd call the anatomy of an investment. You've been following the company a while. And also, if you could just focus a little bit on those discussions that you have with management, because the management team there is highly regarded.
Yeah, sure. Look, I think copper as a commodity call has probably been, if it's not been number one, it's been sort of in our top three commodities for the last 6 or 7 years. This is not like a
Right.
new
Yeah.
call. Like the ongoing supply challenges for copper have been
Yes.
coming for a really long time, and I think a lot of people like myself have been in the commodity space for a number of decades. We sort of often joke that you know copper's been going to have a deficit, for the last couple of decades.
Yeah.
And it's just never quite happened. However, in the last couple of years, we're starting to see deficits, and we think those deficits are really going to start to increase, which will maintain higher prices for the commodity itself in coming years, and mainly because of that AI,
Right.
data center capital
Necessity.
spend thematic has really, changed the outlook for copper in our view. So we like copper. Then how do I express my view in copper? So over the last sort of 5 or 6 years, we've had, very significant positions in the world's biggest producers. So everyone from Freeport to Teck to Anglo, um, Glencore, the bottom of the cost curve, if you will,
Okay.
the cheapest, the lowest cost producers in the world. These sorts of companies were, they were also trading really cheap. So you didn't
I
really
know.
have to go too far if you wanted to put a copper bet on
Yeah.
4 or 5 years ago. You could buy what I would say the highest quality companies at very
Yeah. 5, 6 times cash
very
flow. Yeah.
acceptable multiples, um, and in a sort of Buffett sort of sense that ticked all the boxes, if you wanted exposure to this sector. I would say in the last couple of years we've seen a decent re-rating of those sorts of stocks. I mean,
Yes.
stocks like, Freeport went from under $10 to, over $70. They're still trading within their mid-cycle multiple.
Yeah.
So I don't think they're expensive. But what we've noticed, particularly in the last couple of years, particularly in the last sort of 6 or 12 months, that your smaller development stories in
Right.
copper are still trading significantly cheap. Um, like very low single digit forward cash flow multiples.
Right.
And this is something that we saw in gold 3 or 4 years ago, where, these smaller, medium-sized development stories were trading
Yes.
really cheap
Yes.
versus the large caps. And so I think something, the potential for something very similar to happen, in
Yeah.
these mid cap, smaller emerging copper stocks is, the potential for them to re-rate significantly, like we've seen in the gold space, is quite high. So we like copper. We've owned big caps, but we've now rotated the portfolio into more of these smaller names. So, in Australia, stocks like
Yeah.
Aeris is trading on 2 or 3 times free cash flow, like super cheap, really cheap. Got
Yeah.
good outlook in terms of resources. Plus 10 years of mine life. Mine life's probably going to increase with more regional drilling. Very stable operating, um, production, all of these
Right.
sorts of things. So stocks like Aeris, Cyprium is restarting the Nifty mine in Western Australia. They're
Mr.
going to
Fifield.
be
Yes.
producing, 20,000 tons of copper,
Yeah.
hundreds of millions of dollars of free cash flow, run rate, I would expect within the next sort of 18 to 24 months. But then they've also got regional exploration, and then they've also got the potential to do a big open pit. So sort of like a three-legged story.
Yeah.
Something like Cobre is
Yeah.
exactly the same, very similar story, just in Chile
Right.
versus Cyprium, where you've got an oxide story. It's already producing. They just made an announcement quite recently that they're already generating free cash flow. They've
Yeah.
got a clear pathway to 20,000 tons of production, which would, be a couple of $100 million of free cash. They've got a really exciting regional exploration story, and then they've got the potential to build a large, open pit mine. So we just see that there's
Yep.
more value coming slightly
Yeah.
down the curve um, than the larger caps, and so those sorts of stocks. You asked about Cobre.
Yeah.
We see multiples of upside in
Yeah.
those sorts of stories, 3 to maybe 10 times over sort of the next 3 years, versus the large caps, which are now looking a little more fully valued.
Right.
They're also the reason why you're positive on the commodity itself, because all of those supply challenges, whether it's permitting, whether
Right.
it's inflation, they're probably most pronounced at the bigger end of town. So, they're going to have the most production issues. You've seen that in the last 12 months. Most of the major companies are downgrading their production. And you probably one of the biggest themes within the theme is
Yeah.
this buy versus build mentality from the majors. So the majors are pretty much across the globe are saying we're not going to spend money on exploration anymore. We'll let
Right.
other people do that. We're not wanting to bring our own mines into production. It's too expensive. We're happy to buy them. So
Interesting.
it's another reason to tilt the portfolio more towards these development stories
Yeah.
that are very likely to be taken out. And you're going to get that takeover premium on top.
Now, Ben, I have to ask you, and mining, it's a tough business, as you know. They always have delays and cost overruns. How do you, at the smaller end, work with the management teams to handle these issues? Because inevitably, a Cobre is going to listen to you a lot more than, say, a Freeport will.
Yeah, I think just given our size, if we go into smaller companies,
Right.
we're given we're managing multiple billions of dollars.
Right.
We've got to own a lot of these companies, for it to be material.
Yeah.
Normally own sort of 10, to 15% of those sorts of companies, like we do in the Cypriums and
Yes.
and Cobras, etc. And so if we obviously are taking a liquidity hit
Right.
when you take those sorts of position sizes, we can't just sell tomorrow. Um,
No.
we're by definition in it for the long run. So we need that
Yes.
margin of error in terms of the valuation point that we're investing in. So we've
Yeah.
sort of talked about that there is a compelling, valuation arb versus the, larger, more liquid companies. But when we do take those sorts of positions, a lot of the time we want to become actually the company's corporate advisor as well.
I see.
And we have an advisory business. We call it the merchant banking model. The merchant banking model was certainly what, I cut my teeth with, uh,
Right.
you know, at Macquarie Bank in the late 90s, 2000s, where you'd invest equity
Yes.
in companies. You'd get a right of first refusal in terms of any credit that issue. You'd have your advisory team in there advising them, get defense mandates, etc. Then you'd have you'd put your balance sheet there. You'd be trying to hedge their commodities, hedge their
Right.
currencies, etc. You'd really try and
You have
own
an
the
alignment of
company, the
interest, though.
relationship, and go with them on the journey. And after 2008, the global financial crisis, the changes to Basel III in particular, but
Yes.
also Dodd-Frank, Volcker, pretty much overnight that changed the commodity um, financing industry, where
Yeah.
Tier one capital was no longer inclusive of commodities themselves, and it certainly didn't include mezzanine finance. So
Right.
that merchant banking model really went out the window on the back of Basel III, Volcker, and other capital adequacy changes. And really, what we've done at Tribeca is just recreate that exact same model,
Yeah, the
but in a
proprietary trading
non-deposit
groups.
taking
Yeah.
framework where in a hedge fund environment. And so to your question, we want to take these very long-term views with great assets and great people when it comes to these sort of smaller development type players, and go with them on the journey. And in terms of alignment, I think the
Yeah.
merchant banking model works both ways. The companies know that they're going to get a
Right.
great long-term shareholder, and we know that we've got great access to the company, and the company's going to listen to what we think.
Right. Hey, Ben, we have to keep it short. Unfortunately, I could spend hours talking to you. But in closing, for people that are listening right now that say to themselves, "We love this idea of alignment. We like how you're expressing these views, but frankly, we can't always do it ourselves." How can they get access to Tribeca very easily? Because it is very easy to get access.
Yeah, we in terms of the resources mandate that I run, we've got an Australian unit trust, we've got a US dollar Cayman fund, and we've got a listed version listed on the ASX TGF. Um, all of those three structures are run pari passu, and so investors, can choose whether they want to come into the unlisted funds or the listed fund. The listed fund's obviously got daily liquidity. It's trading every day. It's trading at a discount. At the moment, we think it's a great entry point. I'm the biggest shareholder of the company. I keep buying stock. I've been buying stock for years. I think it's a great investment. The shares have sort of doubled over the last 12 months, but I think there's still trading at discount. I think there's still a lot of upside. I think, capital returns have become a focus, particularly, with the awful, budget that, we received in Australia, and the impact on capital
CGT, yeah.
gains and what have you. I think fully franked dividends have become even more important than ever. And, so, a company like TGF, we're generating, meaningful, franking credits, thanks to great performance over the last 12 months. And so, I'm not on the board of the company, but I would expect that, the company has the runway to increase, dividends over the next 12 months. And, therefore you're getting, you know, uh, great exposure to the sector, trading at a discount that's going to pay, nice
Right.
dividends along the way.
And
So,
a strong track record. Yes.
and a good track record, yeah.
So, Ben, thank you so much. We will put links to Tribeca into the show notes. Please stay in touch. This is such a great conversation. As I said, if people want, maybe we'll do a part two follow up. Ben, thank you so much for your time.
Thanks a lot, Greg. Thank you.